Hi guys, welcome to the FX Street webinar. My name is Ian Coleman. I'm one of the directors, traders, analysts at Pia First. We're an analytical company that produce trade recommendations in 27 products, I think now, just on an intraday basis. We do post some medium-term videos looking at the bigger picture. Basically, our analysis is based on a set amount of indicators. So we've got some bespoke indicators that highlight us to support and resistance. We then overlay these on the charts. We use our knowledge in technical analysis. We're all trained, or if not trained, we are in training for the SCA diploma. So we overlay our bespoke system onto the charts, and it's from this that we produce our trade calls. We have quite a good hit ratio. Have a look at our website. It's got our P&L on there. We don't just produce P&L in pip value either. We also now produce it in percentage terms, and it makes quite interesting reading. What we look to do on these sort of bi-weekly webinars is 1 week I'll talk about currencies. The other week Steve will come in, he will talk about, he's my partner, business partner, he'll talk about commodities, fixed income sometimes, and indices. What we're going to start with today, we're going to break down the dollar index. Obviously we've got 8 FX major pairs. Of those 8 FX major pairs, 6 have the dollar involved in them. Okay, so a lot of the time, if we can get the dollar right, then we have a very good chance of getting the calls right in the majority of the FX majors. So it is a major part, obviously, of most TA's analysis if they're concentrating on FX majors. So the first chart we've got up is actually the dollar index daily chart. Now, this is quite an important chart. We saw some consolidation from March 2015 until October 2015. We then had this impulse breakout. At the time of the breakout, we obviously went bullish. We thought that we were going to break to the upside, and this was based around a Fibonacci extension tool. So we just laid this on top. We looked at this being a 161.8% consolidation area, and then the pair breaking to the upside, or the index breaking to the upside, I should say, but it didn't. It stalled around about a previous high, and then everybody's been highlighting the possibility of a double top formation. You've got to remember, a double top formation is not confirmed on this index until we see a break of this level, which is 92.50. Okay, it has to break the swing low. So we did have a double top, and then we had this choppy area. We had a decent move to the downside, and then we had this consolidation or choppy move higher. When we see these erratic moves, okay, they're mixed, volatile. It normally means that they're corrective sequences. We normally want to see them in 3 waves. We normally don't want to trade them. Okay, we want to trade the impulse move. So we had this consolidated period for December and January, and then we had another impulse move to the downside. However, it has stopped, and it's retraced from this, a test of this this channel breakout. So basically what we look at is this was resistance, it breaks, we then extend the line down, and this becomes support, and we've bounced off that support, and we've now moved higher. Okay, the medium-term bias or the long-term bias for the dollar index is firmly bullish as far as we're concerned. In fact, if we break it down into higher time frames, if we look to a weekly chart, we can actually see that there's no real reversal formations. We had an outside week here, okay, inside Arami, and then we've had an inside Arami breakout here. And it's not really until we get onto a monthly chart that we can highlight where we think that this index is going to go to. So again, we're just going to use the Fibonacci retracement tools. We don't need all of these on here. Just break off some of the less relevant ones. Okay, so this level here is pretty irrelevant. Apart from looking back, we can see it was quite pivotal. Okay, in sort of 97, 98, sort of broke that level, hung around this level in sort of 2003. But it's not a 50% pullback level. It's not a 61.8% pullback level. And if we can see here on the monthly chart clearly highlights a decent rejection of that channel. So the bias now is again to the upside. You've got to remember we've got 29 days in February this year, so this is the last day of the month. It's very unlikely if we're going to close anywhere near the downside. In fact, we've recaptured the majority of the initial losses. Now, if we then go back to our fib tools, okay, this is the area that we're looking at, this 102 area. So we've got 61.8% pullback level is at 102.10, and then we've got a 161.8% extension level from this move here at 101.95. Now, obviously, on the monthly chart, that's only a 15 pip difference. That's quite a tight gap, if you like. So that's what we're looking for over the long term. Now, obviously, our pockets aren't that deep. I don't know if yours are, but we need to break down shorter time frames to try and get decent levels to get onto the longer trend. And I think at the moment that this dollar move to the upside, if we go down to shorter time frames, I think this move to the upside is nearly exhausted, and we'd prefer to buy into a dip over the short term. So if we just put some lines on here, okay, we're not a million miles off the top of a bullish trend channel. Okay, two other factors that lead us to believe that this rally in the index is going to be short-lived. You've got to also remember, just breaking away a little bit, if we look to our calendar, there's little in the way of any decent economic releases today. Okay, we've got pending home sales, unlikely to move markets. We've got some Japanese figures overnight. We've got some small Aussie figures overnight. Tomorrow we've got the RBA statement about 3:30 in the morning. Then we've got some Swiss figures, European unemployment figures, but we've got no real impact figures until probably tomorrow afternoon at 3 o'clock when we've got the ISM manufacturing figures. So this trend up until that point is probably going to stay in, okay? But we don't expect it to break much above this channel. We've got a demark correction count on the daily chart. Okay, that's a 9 count. Now, basically what demark says is that most people don't trade 9s. Okay, most people trade what they call a 13 count. And a 13 count only starts after a 9 count. So the 9 count, demark says, will normally highlight a correction, not necessarily a reversal. There was a 13 count here on the daily chart. Okay, and then we saw this strong move to the downside. This move to the upside, and I know I'm not on the daily chart at the moment, by the way, and this strong move to the upside, Friday posted a demark 9 count. Now, what demark says is that it doesn't necessarily have to correct from the 9 count. It can correct up to 4 candles afterwards, and that's why most people don't trade 9s, okay, because they're not guaranteed to work. I know nothing's guaranteed to work, but there's a very good chance that they're going to extend. However, on the 4-hour chart, we're on an 11 count on the demark indicators, and it's looking like 98.65, which that trendline resistance will probably produce a 13 count, and that's why we don't think that this immediate rally is going to extend too much into this week. And like I said, probably tomorrow, ISM manufacturing is probably going to be the figure that reverses or corrects this this strong upward dollar move. We can reflect that bias now back onto the other FX majors. Anybody got any questions about the dollar index to start with, or what we've been talking about? So just to reiterate, long-term bias is bullish. We're looking for a move up towards that 102 area. Over the short term, we think that this rally is coming to an exhaustion point, and we're probably going to see a move to the downside for the latter part of this week, probably from tomorrow afternoon. So in other words, long-term traders should be looking or swing traders should be looking to buy dips in dollars at better levels. Intraday traders should be very wary and probably looking for this dollar rally to exhaust to then turn the positions round. Okay, no questions? Cool. Hopefully that means that I'm being understood, or hopefully it doesn't mean that nobody understands what I'm talking about. So we're going to look again at the big picture first. Okay, and euro dollar. I'm just going to get my other charts up down on my other screen. Move that across. So euro dollar, again, it's a great time to look at the monthly charts. Last day of the month, what do they show us? You might turn around and say, well, we can't trade off monthly charts. No, you can't. But what we've mentioned before as well is what we call acute monthly reversal candles. Okay, and they might be evening star formations, morning star formations, a doji. My favorite candle formation by far is an engulfing or a bearish or bullish outside bar, slightly different than an engulfing candle in the fact that it actually takes out the full range of the previous candle. So if you look here on a monthly chart, this is a bearish outside bar. So it's acute monthly reversal. Morning doji star, acute monthly reversal. Inside a Rami breakout, outside bar. And then what have we got here? Nothing. It's awful. Very hard to trade or get a bias from this monthly chart at the moment, because we've had so many spikes, so many rejections of gains, and mixed and volatile trading really. But what we have got, which is the reverse of the dollar index, is we've got the majority of this month's gains being overturned. Okay, so sellers have returned to the market and they've pushed euro dollar lower. So where's the long-term objective for euro dollar pair? Well, it's got to be parity. We've got a 161.8% extension level, which is sat here at 10085. We've got a 78.6% pullback level at 98.98. Okay, so that's our area, if you like. We'll be able to be a little bit more accurate when we see, hopefully, the dollar index getting to 102, the figure. And then we'll be able to sort of forecast a little bit better where this could potentially get to and potentially turn around from. So if you look back here, and then we've got this trend line support at 90, I think it's 96.83. So that's our area over the medium term or long term that we're going to be looking at. But just because we're looking at that over the long term doesn't necessarily mean that we're just going to sell it blindly intraday. And in fact, if we break down time frames again, so we could now go to the daily chart. This was an expanding wedge formation that we talked about for the majority of 2015. And again, going back to that dollar index and going back to that monthly chart, that's why we had all this mixed and volatile trading, because we're in an expanding wedge formation. Expanding wedge formations are by far the hardest, or one of the hardest chart formations to trade, because unlike, say, if we had a normal wedge, so we've got a wedge like this, Okay, so we've got an ascending wedge formation, got an eventual bias to break to the downside. When we're in the ascending wedge formation, okay, price is getting tighter, like a spring, and then eventually we unload and bang, all the stops get taken out from the bulls, and we move down in the target levels of the beginning of the wedge. So when we're looking in there, we know that the range is going to get smaller. Again, an ascending wedge formation, fantastic chart pattern, got about a 70% chance of it breaking the right way. So then you're looking for bearish reversal patterns either inside or on the breakout or even on a retest. But your stop loss is pretty limited and your reward is pretty big. So that's one of the best chart formations to trade. And expanding wedge formation is the opposite. As we keep moving within the wedge, then price action can get bigger and bigger and bigger and bigger. And even when we break out, it's very hard to notice a definite area of support or resistance where you're going to want to place your stop. But anyway, we did break out of this wedge formation, similar to the dollar. Remember the dollar, we broke out of a channel formation. We've had a retest of the trend. So this is the trend line support, breaks out, impulse move higher. That was based on fundamentals, as is most moves. We're obviously looking to combine fundamentals with technicals. This was where basically when the ECB turned around and said we're not going to do any more QE, etc., etc., etc. And then we've had this retest. However, intraday, this is looking overdone. If we break it down to the 4-hour chart, I have no reversal patterns, by the way. We do a lot of squawks on Saxo trading floor, and clients or fellow traders will come on and say, right, where is your support resistance? We say, well, it's X, Y, and Z, and this is where we have a confluence area, or this is where our bespoke levels come in. They'll say, right, okay, we're going to look at buying them. You say, hold on a second. Not until you've got a clear reversal signal. We don't just buy blindly. The trend is your friend, etc., etc., etc. If you get warning signals, then you come out of your short position. You don't necessarily turn it round. And I think at the moment, this is looking exhausted, similar to the dollar index, which with the upward move looking exhausted. I think the downward move is looking exhausted, not as exhausted as sterling dollar, but still to a point where I don't think you want to be re-establishing intraday shorts. Also, I'm just going to show, I think this currency pair out of all of them at the moment is probably the hardest to analyze, because what we've seen is we've seen a breakout of this trend and a retouch, if you like. But then I think we're still hanging around this area here. And if we go into the 4-hour chart, we have this trend. So a reverse trend line was resistance, now support. We have broken it, but signals are looking too oversold on an intraday basis, I think. So what would the play be today? Well, the play would be today to try and sell gains up at this level, because we've had previous areas of resistance here. This is then support. Support's been broken, then becomes resistance. But like I said, I think it looks a bit oversold. So I'd only look to sell in around about 109.62 and then be wary of a potential head and shoulders forming to make a bigger correction. Again, the medium-term bias, this is a 5-wave leg lower. The medium-term bias is bearish. But I'm just thinking that we're very wary about selling into the base. Looking at intraday charts, okay, the 4-hour chart has got an 8 count, so a 9 count is exhausted. The 1-hour chart is on an 11 count. a 13 count, 13 counts exhausted and 9 counts a correction count. So there's nothing to say really that you're going to want to establish new shorts at this level. And in fact, if we even go down to like a 15-minute chart, I have to go further down than that, to be honest. I'm going to say there's a wave count in here as well from Friday. He says, just trying to find out where the top is. 110.68. Wrong time frame. Sorry. This move here. 1, 2, 3, 4, 5. So, you know, yes, still a bear intraday, but wouldn't be selling at current levels. And really, it's a difficult pair to quantify, to analyze. Decent moves this week. Need to watch out to see if this is going to be a reverse head and shoulders formation, and if it is, then sort of 110.60 is going to be a prime area to get short again. Intraday, I think there's a good chance for a bounce from current levels. Long term, though, we're still bears in euro dollar. So cable, let's just get onto the bigger picture on cable. Okay, again, I want to show a monthly chart here. We're very close. Just wait for that data to come in. We're very close to previous support, okay, which you could well target. I just think intraday, again, it's looking overstretched. Some people think this is a head and shoulders formation. Do I? No, because I can't see, and I might be wrong. I can't see sterling dollar getting round down towards sort of 115, the figure. Like I said, I could well be wrong. Talking about those acute monthly reversal formations inside Arami, there's an Arami breakout there. But apart from that, these sort of the bigger time frames aren't highlighting too much to the downside. The daily chart, again, we're looking oversold. And I think it's not until you break it down to a 4-hour chart that this looks like possibly the end of a current trend. So in other words, we've got wave 1 here, 2 correction, down in 3, very small correction in 4, got a gap open here still, and then this 5th wave. So going back to what we're thinking about the dollar index, I think the dollar index got limited upside, so these currency pairs should have limited downside now this week. We're probably going to consolidate around this area. A move back up towards here is worth a short-term short. Okay, about 140.40. Just tell you where our bespoke resistance is. Come on. Our bespoke resistance comes in. Our bespoke resistance doesn't come in until 141.12 actually. So there is a scope for a higher move to the upside. Daily chart has posted a 9 count on Thursday. Remember, we said it's got potentially 4 days until it turns round or corrects higher. Again, I think this could quite easily turn into a head and shoulders and we see a higher correction. Intraday from current levels were pretty flat. Dollar Swiss. I'd say out of all the times actually that we've been doing webinars and seminars and forecasts and what have you for FX Street, today I've probably struggled the most. I spend a couple of hours on a Sunday, every Sunday, Going through all the FX majors, I have a tendency to wipe everything off the screen, then put my trend lines back on, overlay my indicators, look at different chart formations, etc. And this weekend has probably been one of the biggest struggles to look at long-term pictures, because, like I was saying, going back to the dollar index, there's no real reason why it's going to stop at the moment, but euro dollar cable all had quite decent levels, which should highlight at least a correction. And then dollar Swiss, which is close to -1 correlated with euro dollar, again is sort of given a bit of a nothing picture again. And I think that probably highlights the market at the moment, is the fact that, you know, we've had such a large period of consolidation and there's not really a great deal to shout about from where they stand at the moment. I mean, if we look at dollar Swiss on the monthly chart, this was trend line resistance. It then pushed lower. It's then hit trend line support, and again it's pushed higher. I mean, there's so much false data in these higher time frames as well, because different brokers had different lows. Obviously, when the Swiss National Bank pulled the plug, it's hard to know what is a decent chart pattern and what isn't. Obviously, the latter part of 2015, you know, those monthly readings are fine. It's only this candle that we've got to be wary about. But consolidation is what I'm sort of trying to get to. And then even if we break it down into a weekly chart, we should probably see it a little bit better. There's not, you know, if you saw that on a short time frame chart, you'd turn around and say, well, it's non-trending. It's only because it's a larger time frame chart that we're trying to pick the bones out of it. So the daily, again, we've got multiple channels here. We're to break out of this channel, but only to move down and hit support off this channel. Could eventually be seen as possibly a bullish flag, which would then line up with that bullish view on the dollar. But at the moment, let's just get my other charts up on the other screen as well. At the moment, we're a bit in no man's land. We've actually got some reverse trendline resistance at 110.44. I think we've made a 110.38 high this morning. It was a intraday channel breakout. So if we break it down to shorter time frames, excuse me. So we had this breakout higher. I don't think this is a bullish flag. And in fact, DMARC has posted a 13 count on one of the intraday time frames. I'm just going to work out where the stop is for that one actually. So basically what you do with the DMARC 13 count, you take the open of the candle, which is 99.15. You take the close of the candle, which is 99.84. So that's 69 pips. You then add those 69 pips to the high of the candle, 99.87, and that's your stop level. So the stop level is actually 1.0056. So that DMARC 13 count is still alive. We've also got a DMARC 8 count on the 4-hour chart, 2-hour chart, sorry. So it looks like this upside rally is going to be limited, and a prime short area is going to be sort of 10044, which is that that trend line resistance. with a relatively tight stop. I mean, you can put a stop in at 100.60, and that should be relatively safe if this DMARC 13 count's going to hold. And in fact, you've actually got two. You've got it on a 2-hour chart and a 6-hour chart. So again, I don't think that we're going to get much further in the way of this upside rally in the dollar index, and then we'd look to buy into dips. Obviously, this is going to be your sort of prime area, depending on where price is when it reacts back towards this trend line support, probably around 99, the figure. So selling around 40, 100.40, targeting 99, the figure probably looks like a reasonable forecast. Remember, we don't make trade recommendations. This is just a potential move to the downside that marries that sort of that outlook for the dollar that we've been talking about. Dollar yen, big picture, and the dollar yen monthly chart. Any particular reason why you'd want to buy dollar yen on a longer term basis? At the moment, no. Prime support is down here, around about 102, the figure. There was a bearish outside monthly candle, close to the high, then a bit of consolidation. We were originally calling this a head and shoulders breakout, because we were sort of taking a neckline along here. Let's just show you. So a neckline along there, left shoulder, right shoulder, and then a breakout. But I'm not quite sure that's what this formation is, to be perfectly honest. Shorter time frames. Okay, if we look to the weekly, we've just had a bounce off this trend of higher lows. Okay, but again, there's no strong reversal formations. There's nothing to turn around and say, well, yeah, that's a strong bullish outside bar or morning doji star, and we should be taking it higher. There's nothing there. We've just seen a corrective bounce off a trend line support, and in fact, if we just delete all of these, we put our fib level on, we can notice that it's just bounced off a 150 level. So I think what's going to happen here for dollar yen, again, we're just trying to extend it up a bit. So I think what's happened is you bounced off this trend line support. We're then going to break again, but then I think the prime entry, because we've got this 161.8% level here. Let's get rid of those. I think we'll hit the 110, and then the prime short entry for medium term or long term traders is going to be a retest of this trend support. So in other words, a break goes down to 161.8%, quick retest probably about 112, and then a move down towards 100, the big figure. Shorter time frames. This looks like a descending triangle formation. So you've got scope for a mild move up, but again, I think it's probably going to be limited. If we look at the moves up to the downside, these are impulse moves, 1, 2, 3, 4, 5. Pretty decent recovery, but I can't really see a 5-wave pattern in there. And if we break it down even shorter, this is at the top of the trend. Excuse me. We break down even shorter. Okay, and we're possibly going to form a head and shoulders formation before we move back down to the downside. And if we just put the extension on there, it normally comes in around 61.8%. So that would be the prime short entry at the moment for the dollar yen, so about 113.50. Let me just put my other charts up, just see if we've got any exhaustion or our bespoke levels that line up with that that area. So on the 6-hour chart, we've actually posted a 9 count, so it's corrected lower. Shorter time frames, nothing really, but also there's nothing bearish, nothing bullish, to be perfectly honest, in shorter time frames. So that will be our area to get short, or look for short positions, I should say, in dollar yen. I'm just going to see whether or not this lines up with a breakout on 11.45, on 11.04. So good thing as well, a lot of people say about head and shoulders formations. They turn around and say, well, the head and shoulders formation isn't confirmed until it breaks this neckline, and that is 100% true. But the risk reward, if we get correction counts up here, if we get an evening doji star up here, if we get a bearish outside bar up here, then our risk reward is so much better than trading the break. And what we have a tendency to advise is we'd look at taking possibly a short position, maybe a half size around this level, and then adding in the same size here. So in other words, you've then got your full allocation of a trade on around here as opposed to here. So then literally on the break, you're doubling up. You could potentially bring your stop loss into your average entry level, and then your risk reward is also a hell of a lot better than it would have been. So that's what we're looking at dollar yen. We're looking for rallies to be limited. Dollar CAD. Now, this is the reason, one of the good reasons why we should always look at the monthly chart. We've got an area here which got like a pivotal area. We then had a 78.6% pullback level. Then we've had this strong sell-off. If we look over to here, we're going to get some congestion, but there's nothing really in nothing to suggest a move back to the upside, put it that way. In fact, let me just get my other charts on again. If we look to a shorter time frame, not this one, okay, we've had a triangle breakout. So, Allah, if you like, target level or levels. I'm always a bit wary of these, not necessarily the breakouts, but I'm always wary of where you take your target from, because you can say, well, is this the start of the triangle formation, or is this the start of the triangle formation? So you're better off actually just noting both breakout levels to dictate, areas of support. There is a possibility that we might get a retest here, but I don't think it's going to move that far to the upside. In fact, I think intraday rallies are probably going to get sold into. We are still bearish on this currency pair, still quite bullish on oil, at least I am. There is no clear indication this move has come to an end. We did have a 161.8% extension level around 135.65, and I think that move has just been overextended a little bit, and this is now just a mild fourth wave correction before sellers return. Intraday, we've got resistance at 136.12. We're just hitting some support as we speak at 135.45, but we're still looking for a move to the downside. Now, over the long term, we have no support until 129.66. So if we go back to this chart here, let me put that level on 129.66, around about here. There's potential excuse me, let's get my tools working properly for that sort of move. Just bear with me just 1 second. Sorry about that. So over the medium term or long term, we're looking for a move down towards this level, and then before a potential bounce, basically, and then we could form a bigger head and shoulders pattern. But short term, like I said, selling into rallies is definitely the call this week. We could potentially get a move up towards 136.50 for a retest. I don't think that we will. Like I said, intraday resistance is at 136.12, 136.37, and they would be our sort of prime areas to get short. Aussie dollar. The monthly chart, expanding wedge formation, okay, consolidated around the trend of higher lows. We have broken to the downside. We've retested this month. We're going to post an insider Rami on the monthly chart, which is a clear indication of investor indecision. Weekly, we've had, I think, 2 or 3 of the last 4 weeks retest this breakout level and move lower. Could this potentially form a head and shoulders pattern? I don't think so. I think the medium term or long term bias is still bearish. Daily, we posted a bearish engulfing candle from the high on Friday. Okay, the Marubozu level is at 71.80, and we had some bespoke resistance this morning at 71.85. I think it's probably moved a fair bit by now. Just bear with me. Our bespoke resistance now comes in at 71.72. So that's really the prime area to get short, but I don't think you'd want to. I've actually started to build a short position in this pair because I think the retracements could be limited. Prime area to target is 69.80. We look to an intraday chart. Okay, then the 261.8% extension level is at 69.62. This can be seen as a free wave correction. This is an impulsive move to the downside. Like I said, I think this could be limited move higher. Gain signals are far from strong intraday signals, but they're definitely skewed to the downside, especially with that bearish outside bar posted on the daily chart. And the risk reward is quite decent to get short in this currency pair. Stop can be placed, or our stop is placed just above 72, the figure, with that 69.40, 69.60 area. It offers quite a decent risk reward trade going into today. Now, Euro sterling. In a corrective channel formation. is what we need to highlight. Moves strongly off the 161.8% extension level. A double bottom or a head and shoulders formation being broken to the upside. We've now paused, corrected from this previous area of support. So it was support, it's now resistance. If we break down to a weekly chart, this is the head and shoulders. So this is the head, left shoulder, right shoulder, neckline, just to show the target level for head and shoulders. Yeah, 80.49, which is this previous area of resistance. So the weekly chart highlights no particular reason to change for a change of trend. However, go to the daily. Okay, we are looking a little bit overstretched. We're in this bullish channel, but again, if we look to the daily candles, we're just getting dojis. We did get a retracement move lower from the 161.8%. It wasn't in a free wave pattern. It was actually in a triangle formation, and then we've broken that triangle to the upside. So the bias still remains mildly bullish in euro sterling, but I think there's a lot of scope for possibly a larger correction before I move back to the upside. And if we look to the intraday chart, it is extremely volatile. I think since last Wednesday's high. The immediate bias, like I said, is mildly bearish, but there's scope for moving in either direction in this currency pair. Euro yen. Now the monthly chart, similar to the downside potential for using correlation, we have to be bearish on the medium-term outlook or long-term outlook. Obviously, dollar yen with scope for a mild intraday rally, and then we're turning bearish again on that pair. Euro dollar. There's potential for a decent upside rally this week, or correction, I should say, not a rally, before a move to the downside. So if we're bearish on euro dollar and we're bearish on dollar yen, then we have to be bearish on euro yen over the long term. We have seen or had a mild bounce from a 50% pullback level, but we have broken out of this formation to the downside. An ABCD formation would take us down to 117.35. 61.8% is 115.36. So that's our sort of prime target area over the long term. Okay, for euro yen. Again, even breaking down into this time frame, and this is the daily chart. We did post a morning star formation from Wednesday onwards last week, or Tuesday, Wednesday, Thursday. And then the rally was sold into on Friday, and we've continued that move to the downside. We've got a 261.8% extension level down here, but I think there is scope for a higher correction this week, at the beginning of this week, possibly with euro dollar correcting higher, to give us a better short entry for this medium term move. And really to confirm a continued downward, to confirm continued downward pressure, you'd need to see a break of 122.50, which was Friday's low. And in fact, if we just go to very short time frames, that's just highlighting that 261.8 again. If we go to shorter time frames, this last move to the downside. What should we say about this as well, by the way? 1, 2, 3. There's no way you can count 5 patterns in there. So that last move up was corrective. This move down, however, looks to have made 5 waves. So 1, 2, 1, 2, 3, 4. Sorry, 1, 2, 3, 4, 5. We've actually taken a long position this morning at 123. Again, signals aren't particularly strong, but I think we're going to get a larger correction for us to be able to sell into this week. What I would look to do, I do think that this move is going to be corrective. I'd look at an ABCD formation and see if that lines up with any of our bespoke resistance levels. And that comes in at 125.38. We've actually got some daily resistance at 125.65 at the moment. Now I know that that's not 125.38, but our bespoke support and resistance, they're dynamic. In other words, they're not static. So it will move. It will continue to move to the downside. It's probably going to meet euro yen if this is an ABCD formation around that level. So the short-term bias is for a bounce, but the long-term bias is still to the downside. Has anybody got any questions? We're sort of a couple of minutes from the end of the webinar. We've covered all the dollar index and all the major currency pairs. No, nothing at all. Okay, well, I hope you found it informative. Sorry we can't be a bit more precise on our outlook for this week. I think the picture, especially the dollar index picture, is pretty mixed. The long-term view is still for the dollar to be bought, euro dollar to come off. Probably not as much as cable, but the short-term outlook is for the potential for a dollar sell-off and a bounce in those major currency pairs. Okay, guys, thanks for watching. I'll speak to you again in a couple of weeks. Thanks very much. Bye for now.